When an economy slows down, governments don't just sit back and hope for recovery. They step in. Fiscal stimulus is when a government increases spending or cuts taxes to boost economic activity. The idea is simple. Put more money in people's hands, encourage businesses to invest, and spark demand across the country. We've seen this during major crises like the Great Depression and the COVID-19 pandemic. But the big question remains, does it actually create long-term growth or just temporary relief? Let's break down how fiscal stimulus works and whether it truly delivers results. Today, we will talk about what is fiscal stimulus and does it really work. So, before we start, make sure to hit the like button and subscribe to my channel. 1. Understanding fiscal stimulus, definition, purpose, and core idea. Fiscal stimulus is a macroeconomic policy tool used by governments to revive or accelerate economic activity during periods of slowdown, recession, or crisis. At its core, fiscal stimulus refers to deliberate government actions, primarily increased public spending, tax cuts, or direct financial transfers, aimed at boosting aggregate demand within an economy. When households reduce consumption and businesses cut investment due to uncertainty, unemployment, or falling incomes, overall economic activity declines. This creates a vicious cycle. Lower spending leads to lower production, which leads to layoffs, which further reduces spending. Fiscal stimulus is designed to interrupt that downward spiral. The concept is rooted in Keynesian economics, developed by British economist John Maynard Keynes during the 20th century. Keynes argued that during economic downturns, private sector demand often becomes insufficient to maintain full employment. In such situations, governments must step in to increase demand directly. Instead of waiting for markets to self-correct, which could take years, governments can inject money into the economy to restore confidence, stabilize employment, and accelerate recovery. Fiscal stimulus differs from monetary policy, which is controlled by central banks and typically involves adjusting interest rates or the money supply. While monetary policy works indirectly through financial channels, fiscal stimulus works directly through government budgets. It can target specific sectors, income groups, or infrastructure projects, making it a more visible and often politically debated tool. Understanding fiscal stimulus requires recognizing its objective, not simply spending more money, but strategically influencing economic behavior to prevent deeper contractions and promote sustainable recovery. 2. The historical origins and evolution of fiscal stimulus. The intellectual foundation of fiscal stimulus gained prominence during the Great Depression, one of the most devastating economic collapses in modern history. During the early 1930s, unemployment soared, banks failed, and global trade collapsed. Traditional economic thinking at the time suggested that markets would eventually self-correct. However, the prolonged suffering led policymakers to reconsider this approach. In the United States, President Franklin D. Roosevelt launched the New Deal, a series of large-scale public works programs, financial reforms, and social safety net expansions aimed at restoring economic stability. While economists still debate how much the New Deal alone ended the Depression, it marked a turning point in economic policy philosophy. Governments around the world increasingly accepted that active fiscal intervention could play a role in stabilizing economies. After World War II, many advanced economies adopted counter-cyclical fiscal policies, increasing spending during recessions and reducing deficits during expansions. Fiscal stimulus re-emerged prominently during the 2008 financial crisis. Faced with collapsing financial institutions and plummeting consumer confidence, governments implemented massive spending programs and tax relief measures. In the United States, President Barack Obama signed the American Recovery and Reinvestment Act in 2009, injecting hundreds of billions of dollars into infrastructure, education, healthcare, and tax cuts. A decade later, during the COVID-19 pandemic, governments worldwide again deployed unprecedented fiscal stimulus packages to prevent economic freefall. Over time, fiscal stimulus has evolved from an experimental response to crisis into a mainstream policy instrument. 3. The mechanisms, how fiscal stimulus actually works. To understand whether fiscal stimulus works, it is essential to examine how it functions at the economic level. The key mechanism is aggregate demand, the total demand for goods and services in an economy. When the government increases spending on infrastructure, healthcare, or public services, it directly creates jobs and income. Workers hired for public projects spend their wages on housing, food, transportation, and other goods. Businesses that supply materials for these projects hire additional workers. This chain reaction is known as the multiplier effect. The fiscal multiplier measures how much total economic output increases in response to government spending. If the multiplier is greater than 1, each dollar of government spending generates more than $1 in economic activity. The size of the multiplier depends on several factors, including the state of the economy, consumer confidence, interest rates, and whether spending targets domestic production or imports. Tax cuts operate differently but aim for the same result. When individuals receive tax relief, they have more disposable income. If they spend that income rather than save it, consumption rises. Similarly, corporate tax reductions can encourage businesses to invest in expansion, equipment, or hiring. Direct transfers such as stimulus checks, unemployment benefits, or social welfare payments also increase household spending power. However, the effectiveness of these tools depends heavily on timing, scale, and economic conditions. In a deep recession with high unemployment, the multiplier tends to be stronger because unused resources and labor are available. In a fully employed economy, stimulus may instead generate inflation. 4. Types of fiscal stimulus policies. Fiscal stimulus can take multiple forms, each with distinct economic implications. The most common form is government spending on infrastructure projects such as roads, bridges, renewable energy systems, public transportation, and digital networks. Infrastructure investment is often praised because it not only stimulates short-term demand, but also enhances long-term productivity. Improved transportation networks reduce costs for businesses, while digital infrastructure fosters innovation and competitiveness. Another form is tax-based stimulus. This includes reducing income taxes, corporate taxes, or consumption taxes to increase disposable income and incentivize business expansion. Tax rebates and credits are also common, particularly during economic downturns. Direct cash transfers, sometimes referred to as stimulus checks, have become increasingly popular due to their speed and visibility. During the COVID-19 crisis, many countries distributed direct payments to households to prevent consumption collapse. Social welfare expansion is another powerful stimulus tool. Extending unemployment benefits, increasing food assistance programs, or supporting low-income families tends to generate higher multipliers because these households are more likely to spend additional income quickly. Finally, targeted industry support, such as bailouts for airlines, small businesses, or manufacturing sectors, aims to prevent systemic collapse in strategically important industries. Each type of fiscal stimulus carries trade-offs regarding efficiency, equity, speed, and long-term impact. 5. Does fiscal stimulus really work? Evidence and debates. The effectiveness of fiscal stimulus remains one of the most debated questions in economics. Empirical evidence suggests that fiscal stimulus can significantly reduce the severity and duration of recessions, particularly when implemented during periods of economic slack. Studies of the 2008 financial crisis and the COVID-19 pandemic indicate that large-scale government spending helped prevent deeper unemployment and stabilized financial systems. If you liked this video and would like to see more like it, please give it the thumbs up. Leave a comment and click the button to subscribe.